Most economists expect the Bank of Canada to keep the interest rate unchanged, but it is the messaging around that will be watched closely. Let's bring in Pierre-Benoît Gauthier. He's Assistant Vice President, Investment Strategy at IG Wealth Management. Thanks for your time.
Always happy to be here.
So the latest inflation report, as you know, was affected by that GST holiday we had, Christmas of 2024. Is there any value in that metric at all?
Well, right now, the inflation numbers are actually quite close to the objective, right? We can argue about decimals, but really, in the end, inflation appears under control in Canada. So tomorrow, what's going to be interesting is to see if the Bank of Canada agrees with me or not. Are they going to see inflation picking up ahead? Because there are reasons to believe that we could face future inflation. For example, the price of materials, a very strong economy down south. So all of this could surprise to the upside inflation, and they could have a messaging that's very cautious. On the other end, maybe they'll be more concerned about the strength of the Canadian economy, of employment, and probably also a new concern to them is the state of the Canadian dollar. The U.S. dollar has been losing a lot of value in the last few days, so that's also going to be a concern for them, because while the U.S. On the U.S. side, the Fed is very concerned with full employment and inflation. In Canada, there's also the notion of currency, well, without calling it control, currency protection. So tomorrow the messaging will make it clearer which of these priorities is the main priority for the Bank of Canada.
Okay, the unemployment rate did tick up, as you know. So how heavily do you think that'll weigh on any decision here?
Well, at some point, that's what's going to be the tipping point for the Bank of Canada, right, to make it a priority. Last time I was here, we were mentioning that expectations for rates in Canada was actually to go up in 2026. So the markets were pricing in a hike in Canada and pricing in cuts in the U.S. Back then, we were saying that this felt extremely unlikely to us, as it would be too detrimental to the Canadian dollar. And now we are seeing the markets go in that direction too, meaning that hike expectations in Canada still exist, but they are much lower than just 1 month ago, while in the US, the odds of cuts for the whole year are also toning down. So we are meeting halfway, and that shows us that at first, everything seemed to be focused on inflation, and now the bank appears to be more concerned about employment. And I think that is very wise of them if they are moving that way. There is a lot of potential in this economy, and rates right now, while still overall neutral, could definitely help more.
Okay, what do you think, if anything, could shift expectations for the Bank of Canada rate cuts this year as we move forward? What do you think could change their mind? Some drastic tariff decision, perhaps, by the U.S.?
Of course, yeah. That has got to be on their mind, and we have seen that trade worries last year were very much overblown, and now the market, I wouldn't call it complacent, but the market has kind of moved past it, right? But in the real economy, the effects can be seen in some places. So it doesn't mean because the TSX is doing great that the whole of the Canadian economy is doing great, right? So the bank is looking at this. Also, the state of the U.S. dollar is again is going to help them, because if the U.S. dollar weakens a lot, then it gives them a little more wiggle room, a little more breathing room to cut rates. When the Canadian dollar is very weak, if they were to cut more than the U.S., it makes it too weak, and now inflation is dangerous. So it's a very tight rope they are on, but the current state of the economy and the current state of the dollar makes it like they could surprise us and be a little more dovish than last time, hopefully.
Okay, let's talk a little bit about the tone, because with the expectation for the rate sort of not moving, many people are going to look at the messaging. The messaging last time is, we are where we are. It's quite likely we're going to stay here. So do you expect that same messaging to be delivered tomorrow?
Yeah, there's much less, let's call it, pressure from the political side in Canada on the monetary side for being more dovish and more accommodating than down south. So I think that culturally, the Bank of Canada is always happy to be a little more hawkish and at least neutral, right? So we shouldn't expect them to be extremely dovish either. But anything that even looks like an open mind for eventual cut will be seen as a good news, because right now there's not a lot of things pointing towards cut expectations in 2026. So the slightest wording will be taken with great hope by the markets.
I'm sure it will. Pierre-Benoît Gauthier, I will leave it there. Pierre is Assistant Vice President, Investment Strategy, IG Wealth Management.